My next guest says if there's a recession next year, things will only get worse. It could hurt operators' ability to make interest payments. For more, let's bring in Willie Walker, Chairman and CEO of commercial real estate lender Walker & Dunlop. Welcome. It's great to have you here.
Thanks, Kelly. Nice to be with you.
Are you the Walker from that name, or was that, a part of a lineage here?
It's my grandfather started the company in 1937, and then my dad ran it, and I now have the privilege to run it every day.
Wow. Okay. So you guys have been through a couple of cycles. It's interesting to highlight what's going on with hotels because it's not garnering a lot of headlines, and it seems somewhat site selective, but it also seems to stem from higher interest payments and in some cases rising insurance costs.
Well, Kelly, I think you have to think about a couple things. The stat that you just talked about as it relates to delinquencies, those are loans that defaulted in 2020 during the pandemic that are now just getting worked out. And so one of the things that I think a lot of people forget is that commercial real estate is a very slow moving industry, if you will, in the sense that you might have a default, but you're not going to get a work out of that default for several years. And so the thing now as it relates to hospitality is that if we have weakness in the consumer, if we go to a harder landing than currently projected, that will pull back on consumer spending, that will pull back on travel and leisure, and that will then soften the operating of hotels across the country. But so far since the pandemic, leisure has held up exceedingly well. The one soft spot as it relates to hospitality has been office hospitality, if you will, CBD hotels, and they have had weakness, but travel is back and people are traveling to see clients, people are traveling to visit offices. And as a result of that, unless we have a harder landing than projected, I would think that hospitality holds up pretty well.
That makes sense. And I like the first in, first out idea where, yes, we're seeing the defaults, but that's because of what happened 3 years ago. So where do you think we're going to be looking 3 years from now? Is it still going to be all about office?
Oh, first of all, let me just double click on your comment about first in, first out. The issue on hospitality is that they change their rents every single day. Unlike office, where you've got long-term leases in place. So if an office building has problems during the pandemic and people aren't going to the office, the owners still get lease payments from those renters of those offices. And so office has the longest leases, hospitality has the shortest leases, and everything in between, multifamily, retail, and industrial, all sit somewhere in between. Every day the rents get rechanged and the leases change every single day to longer term on office of about a 10-year lease. And so as a result, hospitality is always first in. It's also always first out. But there is a lot of focus today on office and back to office. I would say that people's view on office is actually getting better.
Sure.
People are back after the Labor Day holidays in the office. And I think we continue to see improvement on office fundamentals going forward.
No, I agree that it seems the longer we can kind of draw this out and see that normalization continue and hopefully give those people who are exposed time to work through it, maybe the less pain is going to be felt in the long run. Is there anywhere, look, you know this whole industry better than any of us. Is there anywhere that you're watching where you say, you know what, this is where, kind of the exposures lie and some of the people who could take, we've talked about the banks. I don't know exactly. Just kind of talk me through that. I mean, how do you watch the dynamics playing out here potentially over the next couple of years?
So the first question when rates started to go up was, would we have significant defaults in bank portfolios that would be a solvency issue for any of the U.S. banks? It has clearly so far been an earnings issue and not a solvency issue. Higher rates mean that commercial real estate writ large has a harder time paying their debt service coverage, which brings the cash flows on those properties down. But that doesn't necessarily mean that you're going to get massive defaults, which then make it so you have bank foreclosures. So the first question was, how's the banking system? So far, it's held up pretty darn well. The second question would be, okay, in this higher interest rate environment, where is there opportunity? Where are investors putting their money? First, multifamily has been a great asset class because at the end of the day, people need to live somewhere. People are still paying their rents. People are still living in apartment buildings. And so while the fundamentals of multifamily have fallen off quite a bit, it is still viewed as one of the very strongest commercial real estate asset classes. On the other end of the spectrum, office is the area where everyone has doubts because of back to office. A-class office, Kelly, has held up extremely well. Why? Because those firms that want their employees back in the office want highly amenitized space. They want places where people want to go to work, and therefore they're leasing Class A office space across the country. It's the B and the C class office space that is not doing well, that has significant vacancy and therefore potential for significant default.